Welcome to my channel today. This is the King Shooter. It's the first time of joining us. Ensure you like, comment, share, and subscribe to this channel. Okay. Now today we want to see partnership. Okay, very important topic in accounting. Partnership. Now, basically, we have three business organizations: the sole proprietor, which is known as a one-man business, the partnership, and also the company. So we have seen the sole proprietor, final accounts of the sole proprietor that comprise of the statement of comprehensive income and the statement of financial position. That is the trading profit or loss account and balance sheet. Okay, and now I want to see, we have also seen that of a company. I want to see the partnership. What is a partnership? Now, according to Section 1 of the Partnership Act, it states that partnership refers to a relationship which subsists between persons carrying on a business in common with a view of profit. That is, a partnership refers to a business organization where two or more persons come together, they put their resources together, they join their skill and expertise together to establish a business venture for the sole aim of making what? Profit. That's their main objective for what? For making profit. Okay, so basically the partnership have a minimum of 2 persons and 20. That's for ordinary organization. But if it's for the business firm, a partnership is from 2 to 10. Okay, from 2 to 10. So that is the partnership. Now, basically we have 3 kinds of partner. Basically, other text you might see the limited partner and all that, but basically they have 3 kinds of partner, which is the active partner, the sleeping or dormant partner, and the nominal partner. Now, who is the active partner? Now, the active partner is that individual that takes active part in running the business. Okay, they are always there in the management of the business. Okay, they are involved in the day-to-day running of that business. They take active part in the business. Okay, most time the active partners are entitled to a salary in the business. Okay, apart from their benefits that regards to the share of profit. Why? Because they are always there in the business to run it. Okay, so that's one kind of partner. Also, we have what we call the sleeping or dormant partner. Now, what this aspect of partner does is to contribute their capital, and they are not involved in the active management of the business. Okay, they just contribute their capital and they go back to get profit, that share of profit. Okay, why also the nominal partner? The nominal partner are mostly influential people that have been successful in different endeavors before now, so they contribute their name. Okay, because their name have gotten this goodwill, so they contribute their name to ensure that the business becomes what? Successful. Okay, these are the basic aspect of partner. In some tests you might see what we call limited partner or general partner, but most of this falls under this. Okay, so now, since partnership it's not for one man, it means that involves 2 or more persons, and in a situation whereby we have 2 or more persons, definitely there needs to be agreements that should bind these people. Okay, that should put them together to ensure that they heed to that agreement. Okay, so that agreement in terms of partnership is what we call deeds of partnership. We call that partnership deeds, or deeds of what? Partnership. Now, the partnership deeds is a book or a document that contains the rules and regulations guiding the partnership business. Okay, sole proprietor don't have that because it's a one-man business, but for a partnership it has that because it involves 2 or more persons. Okay, so they should have a laid down principle or guide that should help and guide them. Okay, so that is why it's called deeds of partnership. Now, in deeds of partnership, embedded in it are many items. Okay, one of each is 1, It is the powers, the duties, and the right of each partner. Okay, and the right of each partner. 2, if salary is to be paid, and what amount. If salary should be paid to a partner, and what amount. Okay. 3, there should be interest on what capital. For instance, individuals will have to contribute their capital. So in order to encourage them for contributing capital, so definitely there should be what interest that will be what paid to them. Okay. So the partnership deed will contain the interest on capital at what percentage. Okay. It will also contain interest on drawings, and at what percentage. That is, any partner that is withdrawing any amount, how much is that person supposed to pay to interest as interest to the business. And also if drawings is to be allowed. Okay. And also profit and loss sharing ratio, how they're going to divide their profit. Okay. And also their valuation of goodwill when there is death of a partner or admission of new partner. When they want to get admission of new partner, or they want to revalue their assets, how will they value goodwill. Okay. These are some of the agreements that will be embedded in partnership deeds. Okay. So now when there is no explicitly agreement, when they don't have or they don't state any agreement, now what do they do in this instance? Now when there is no agreement, it means 1, there will be no interest on drawings, there will be no interest on capital, no salary is to be paid to any partner, no drawings is to be allowed. And also when a partner makes extra, that it gives a loan to the business in excess of the normal capital, a 5% interest is to be paid to him. That is when there is no agreement. A 5% standard, static, a 5% interest is to be paid to him. Okay. So those are some of the deeds of partnership, when there is agreement and when there's no agreement. So the final account of a partnership still looks like that of a sole proprietor and that of a company, just slight difference. Okay. So for the partnership, the final account will comprise of one, a trading profit or loss account. Okay. 2, we have the appropriation account. 3, the current and capital account. And 4, the balance sheet. Okay. So we have basically done most of them before. So if you have not seen the video, especially the trading profit and loss account and the balance sheet and also the appropriation, we have done that for the sole proprietor and the company account. So ensure you look at them so for better understanding. So these are the 4 main accounts that will be prepared in terms of the partnership. Okay. So we are going to see them in isolation, one after the other. And the trading profit or loss account comprise of a trading activity and also the profits relating to the business. Okay, so it will record the same way as that of a sole proprietor. Okay, that records both opening stock, ad purchases, and all that. Okay, so we can have a format for that for those that is just joining us. But we have done this before. You can also check our channel there to see it. So we can say the format of the trading profit or loss account as at 31st December, the year there. Okay, so on the left hand side we can have our opening stock as usual. Then we can have add purchases. And when we add that, we can add carriage inward. carried inwards. Then if there is return outward, you can less return outward or purchases return. So say less. Now this will now be cost of goods available for sales. Now when you less closing stock, you now have cost of goods sold. Okay, now we have sales here at the right hand. The sales, then we can have less return inwards. So we have net sales here. Okay, so net sales minus the cost of goods sold will give us our gross profit. That is when what you have here is greater than the cost of goods sold. But if it's this that is greater than this, you have the gross loss. Okay, so here we have a gross profit carried down. So this closes here and this closes. Okay, so the next part, this is a trading account. The next part that we normally join together is the profit or loss. Well, since we have our gross profit here, it will be carried down, brought down here as gross profit brought down. So if we have this, so we'll have expenses as regards there. So we'll have expenses like discount allowed. We have bad debt. We have depreciation. We have insurance. We have administration and selling expenses, and all other expenses will be processed there. So the income, we can also have discount receive here. We can also have commission receive here. We can also have reduction in the provision for bad debt here. That's an income. So when all these parts, you add up all these expenses and the income is greater than the expenses, you have a net profit here. So when you add together, have this and you have this. So you see, look the same way as that of a sole proprietor. Now we have done that before, where I took my time to explain each and every one of it and why it is there. Check in the previous video. I'll drop it up here, or I'll drop it in the description, or you check the final account of a sole trader. Okay, in the channel, you will see it there explicitly, where I explain all this one after the other. Okay, so now the next one, this is the trading profit or loss account. The next one is the appropriation account. Now the appropriation account is where we make necessary adjustments as regards the partnership account. The partnership activities, okay, where you take into cognizance, you bring your net profit and the interest on capital, when there is salary to be paid, and also where you distribute the profits to the individual partners. That is where it is embedded. So the appropriation account is also recorded in a tabular form, in which the right hand side will comprise of the benefits of the partnership business itself. Okay, the right hand side, it's the benefits of the partnership business, while the left hand side is what the partners are entitled to the business. Take note, the right hand side is what comes into the business, the entitlement of the business itself, while the left hand side is what is the entitlement of the partners in the business. The entitlement of the partners in the business, okay, is recorded at the left hand side. That is what the business itself is meant to pay the partners. Okay, so the partnership, the appropriation account, if we have it here, So if we have appropriation account, so the appropriation account, we can have our net profit. This net profit that is here now is brought down here. Okay, net profit brought down. Okay, so that is net profit brought down. So the next one will be interest on drawings. Interest on drawings. So how many partners collected that? You can write the partners individually and put that amount, the interest on drawings. Okay, I will explain this. Now we can have salary here. Remember I said the left hand side comprised of what the partners themselves is entitled to get from the business. So the salary is to be paid to the active partner or any other partner. Okay, so that's salary. Then the next one is interest on capital. Interest on capital. Interest on capital, if it is for capital for partner A or partner B, whatever amount. Okay, the same way interest on drawing for capital partner A and partner B. Okay, so the interest on capital, the total amount will be added here and brought down here. Now remember I said this might not be limited to only these two, but I said this is what the partnership business is entitled to. The business, this is what they will receive, the business, while the left hand side contains the partners, the entitlement of the partners in the business. Okay, that is what the business will pay to the partner. Okay, so when you get to this point, now if what we have at the right hand side is greater than this, what we have here, it means there's a profit. It means what they receive is greater than what they will spend. That's the business. So they will have a profit. Okay, what you have here at the right hand is greater than what is at the left hand. This means what they receive is greater than what they are paying out. So at that point, they will have what? A profit. So that profit now will be shared between the partners in their profit or loss sharing ratio. Okay, now I said that when there is agreement, definitely they will embed in it how they want to share their profit. Okay, if there are two partners, they can decide to share it 3:2, or they can decide to share it equally depending on the ratio. Okay, if there are four partners, they can decide to share it at a particular ratio or percentage. Okay, so when they have profit or they incur loss, that is what that ratio will be used for. So in this situation now, if we have this as the credit side, what the business receive and what they pay. So if what they receive is greater than what they pay, they will have a profit. So you can have a share of profit here. Share of profit. So A will share it as regards their ratio and whatever amount that is there. Then also B will also share as regards the ratio. Whatever amount that is there, you add it up. Okay, then it has to balance automatically because the balancing figure is not the profit that was shared between them. So it will balance automatically. Okay, in the same way also, if what they are paying, salary and interest of capital and other things they are paying is greater than what they receive, what they will have here is share of loss. Okay, it means there was loss, so they will have to share that loss as regards that same profit or loss sharing ratio. Okay, so that is how the appropriation account will look thus. Okay, so that's appropriation account. Now the third one is the current and the capital account. Now the current and the capital account, in current account is where you record all benefits that accrues to the partner. Okay, while the capital account is where you record their capital payments they brought into the business. Okay, now this current and capital account section is dealt with in two ways. Now we are going to see that now. Like we said, this is where you record the amounts they contributed as capital and the benefits that they get, that is accrued to them. For instance, You see here salary, interest on capital, and share of profit. This is what the partners get from the business. Now it will be posted to what the current and capital accounts. They are in their individual account. Okay, so the current and capital account can be seen in two ways. Now the first one is what we call the fixed capital and the current account. The current and capital. So the first one is what we call the fixed capital and the current account. Now what this means, let's write it, the fixed capital and current account. Now what this means is that we have a fixed capital, we have a separate account for each. The capital account is separate while the current account is separate, meaning that the capital account is static with only the amounts they have contributed to the business. Okay, while the current account records other benefits they have in separate accounts. For instance, we can have their capital account like this. The capital accounts so if it is two partners A and B, so they can just write their capital as what they brought to the business depending on the amount. Okay, and that's all their capital. Okay, then you open another account called the current account. Open an account called the current account. Now, this is the middle. Now, the current account is where other benefits that accrue to them is. Okay. Now, the right-hand side will record items that they are receiving, that is coming to them. Okay. While the debit side will record items they are supposed to pay to the partnership business. These are individual partners now. Okay. The credit side will record items that they will receive from the business, while the debit side will record items they will have to pay back to the business. Okay. For instance, now here's the particulars. This is the individual partners should be recorded here. They are individual partners. So the first one can be the balance brought forward, that was brought forward from previous sale of the current account. It should be stated there. Okay. Now, if any partner have salary, probably if partner A that have salary, it will be recorded there, and this dash. Then, if they have share of profit, it will be recorded there, the share of profit. If they have interest on capital, it will be recorded there. Okay, so that is. Also, in the same way, in the debit side, you record there their drawings. Probably they made drawings, they withdrew an amount from the business. It will be recorded there as drawings. Now, if interest is to be charged on drawings, it is also recorded there. Okay. Now, after which you can have a balance carried down when this is greater than this. So the balance carried down will balance everything up. So we have a final balance. Okay. So we have a final total that covers everything up. This is the fixed capital and current account at separate interval. Okay. Now the second way for this current and capital is what we call capital account without a current account, which is also known as fluctuating capital account. Fluctuating capital account. What this means in this situation is that you don't have to prepare them individually, you join them together. That's why it's called fluctuating capital account or capital account without current account. So at this point now, the only thing that will be written there is capital account. Capital account. So the same way we recorded this, the same way we'll have the partners A and B. Now, since this is capital account, so you pay any money to be brought forward as balance brought forward. Now, for current account, if there's any money in their current account, it can be brought here as current account. Record it. The same way, if they have salary, you record it. If they have share of profit, you record it. If they have interest on capital, you record it. The same way at the debit side, if there's drawings for A and B, if there's drawings, you record it. If there is interest on drawings, you record it. Then you can have a balance carried down. Okay, so you can see it is quite different from this. Why this you was splitted, the capital account and current account was splitted, but for this they are what added together. So that's why it's called fluctuating. So at that point the capital account will fluctuate because of the changes in this, but for this capital account is static. Okay, so that is in terms of the current and capital. This is where you record their individual entitlement. Okay, so that is the third account that is to be prepared. While the fourth one is the balance sheet. Okay, we have done and prepared the balance sheet in several occasions. You can also see that in sole proprietor. The only difference here is that you have to record what you get in the capital account there. Okay, now let's see that. Okay, now let's see the balance sheet. Okay, and this is the format for the balance sheet. Now the same way, if we start from our right hand side of the balance sheet, now we'll have hello? Okay. Wow. Okay, now let's see the balance sheet, the format, this is the format of the balance sheet. The same way, our right hand side of this balance sheet, if we have the fixed asset, whereby we can have the cost, depreciation, and net book value. Okay, we can have plant and machinery. The cost, if there's depreciation, you deduct it, then you get a net book value. Then we can have furniture, okay, and other fixed assets that can come under this. Okay, whereby we have the cost, deduct the depreciation to have a net book value. Okay, now we can also have the current asset. So the current asset can be stock, can be debtors after you've deducted both bad debt and provision for bad debt. It can also be prepaid expenses. It can also be cash. It can be bank. So all current assets will be here. So we have done this before. Check the final account we've said before. You see both the balance sheets there. Now in the left hand side here, it is quite different from the sole proprietor. Now since we have the capital to be contributed by the different partners, we are going to state it there. Okay, so in this now we are going to state the capital now for partner A and partner B, you add it together, you bring it here. Now you can also state the current account, the balance of the current account. Now where would you see this balance carried down here? The balance carried down here, okay, when you have added this and deducted this from it, the balance carried down here is the balance of the current account. So this is where it will be posted. So A, you post for A, B, you post for B, and you add it together. Okay, then you can also have current liability. So drawings is not coming to this account. Why? We have already taken cognizance of it in the individual current account. Okay, take note. So we have creditors here. Creditors is here. We have accrued expenses is here. We have bank overdraft is here. When you add it together, you have this. Okay, so when you add this, it should balance automatically. Okay, it should balance automatically. So to see more of the format of the balance sheet, where I explain each and every one of them individually, check the final account we have said. Okay, so in this now, so this is the format of the balance sheet. In this now, that is showing you the trading profit or loss account. We have seen it. The appropriation account, look at it. The current and capital account, and the balance sheet. Okay, so in this situation where you post this, it means you are using this and not this. Okay, if you are using this, it means the balance carried down will just cover everything here. Okay, so that is that and that. So the normal let me explain this one after the other. Interest on drawings. Now, drawings is getting money back in terms of cash or goods, okay, by the partners from the business. Most time the partners might have an emergency whereby they don't have their personal cash, so they might want to get from the firm, okay, from the business. So most time you have to discourage people from borrowing, so that the only people that will be allowed to borrow are those that have reasons for borrowing, and not anybody waking up any day to get money. Okay, so they put some interest, okay, in order to discourage people from borrowing much, and also it can serve as income to the business at large. So they put an interest there, so that anybody that is borrowing that amount will have to pay the interest. Okay, so the interest on drawing is a charge on drawings, okay, by the partners. So when there is interest on drawings, as we have seen here, you are going to debit the current account, the individual's partner current account, and you are going to credit appropriation account. Okay, we have seen it here now, where you debit the current account, you credit the appropriation account. Look at it here. So another one can be salary. Like I said before, salary is that amount that is paid to an active partner. Okay, so when they pay to an active partner, he receives it. So when he receives it, it is credited to his current account, and the appropriation account is debited. So you debit appropriation account and you credit current account. That is salary. Another one is interest on capital. When there is interest on capital, I said in order to encourage people in the capital they brought, they pay them interest on it. So interest on capital, you debit appropriation and you credit the partner's current account. Okay, so another one is the share of profit. The share of profit, meaning that what the business received and what they paid what they receive is in excess to what they pay, so they have a profit. So they share their profit as regards the ratio. So when they share a profit, you debit appropriation account, what we are seeing here, and you credit the current account of the partners. Okay, and also the share of loss if there's share of profit. In the same way, if there's share of loss, it is the reverse of share of profit. So the share of loss will appear at the credit side of the appropriation, and at the debit side, though we do not include it here, but it's always at the debit side of the current account, since there's share of profit here. Okay, share of loss is at the debit side. So you have debit current account, and you credit appropriation account. Okay, why the last one is the drawings. When there's drawings, like I said before, drawings. Now when there's drawings, what do we do? How do we take this? When there's drawings, debit the current account, and credit the drawings account. Debit the current account and credit the what? Debit the current account and credit the drawings account. So this is basically how to solve the partnership final account, ranging from trading profit and loss account, appropriation, current and capital, and the balance sheet. Okay, now let's see a question on how to solve this. Basically, how to solve from the appropriation and the current and capital accounts. Let's see a question on how to solve this. Okay, don't go anywhere. Okay, welcome back. Now let's see this question. It reads thus. It said, Shegun, Ayo, and Biodu are in partnership. The share profit and loss in the ratio 5:3:2. So this is the profit or loss sharing ratio, respectively. The partnership agreement contains the following. A. The partners' capital are Shegun 40,000, Ayo 15,000, Biodu 25,000. B. Ayo to receive a salary of 6,000 per annum. C. Interest on capital is to be 5%. D. Interest on drawings to be 10%. They said in the year 31st December 1992, the net profit was 30,000. The partners' drawings were as follows. Shego withdraw 7,000, Ayo 5,000, Biodu 3,000. So they said the current account shows the following balances. Shego 1,000 should be credited, Ayo 200 should be debited, Biodu 100 should be what? Debited. You are required to prepare the appropriation account and the current account for the year. So most time you can see questions like this whereby you're required to prepare the appropriation and the current account. Okay, so in this situation now, what do we do? Just no item that is supposed to come to the appropriation account. Okay, that is very important, because most time they might give items that might not come here. Okay, to know if you actually know what is supposed to come here. Now, in the preparation of appropriation account, we said the credit side contains items that will benefit the business. So one of it is the net profit. The net profit. Now, from here now, they said in the year 31st December, the net profit was 30,000. So net profit is 30,000. 30,000. Okay. So the next one, what is supposed to be here is the interest on drawings. Interest on drawings. Okay. Now, for the interest on drawings, now watch. We have to use the percentage given to us. They say the interest on drawings is to be 10%. Now, to be calculated on the drawings that was made, they say the partner's drawings were as follows. So Shego withdrew 7,000. So he's going to pay 10% on this. Ayo 10% on this. Biodu 10% on this. So that is what we'll calculate here. The first one is Shego 10/100 times his drawings is 7,000. So this will give us 700. The next one is Ayo. Ayo is still 10%. 10% of 5,000. It is 500. And Biodu is 10% of 3,000, it is 300. So we have 15. Okay, 15. So we'll come to this part. What is supposed to be here now is salary. Are they paying anybody's salary? Now we're going to check. It said Ayo to receive salary of 6,000. So we're going to put salary or put the name of Ayo is receiving salary of how much? 6,000. Okay. So another item that can come here is our interest on capital. So we'll have interest. We'll have interest on capital. So the interest on capital now is what the business will have to pay to the individual partner. So they said the partner's capital are Sheku contributed 40,000, Ayo 15,000, Biodun 25,000. Now their interest on capital is 5%. So we are going to calculate 5% on their individual capital. So that will now be Shegun 5/100 times 15,000, which is his capital. So if I use my calculator, Shegun is 40,000. So if I use 5% of 40,000, I'll have 2,000. The next one is Ayo. The same 5% of 15,000. So if I use 5% of 15,000, will give me 750. And the next one, Biodun, 5% on 25,000. So if I use 5% on 25,000, it will give me 1,250. So if I add these three together, it will give me 4,000. Okay, so it will give me 4,000. So 6,000 plus 4,000 is 30,000. Why 30 plus this is 31,500. So it means that what the business receive is in excess to what they'll pay out. So there is profit, as the credit side is greater than this. So since there is profit, it means they'll have to get their share of profit. You have to get your share of profit. So before we have to know the share of profit, now this is, if you add this plus this, it will give you 31,500. Now this is 10,000. So 31,500 minus 10,000 will give you 21,500. So the profit is 21,500. Why? Note, the credit side, the profit is 31,500 minus this is 10,000 to give us 21,500. So this 21,500 is what will be shared among them as their profit. This is a profit now. So it will be shared within this ratio. Okay? 5:3:2. It means the first name that comes first have this. The second name have this. Third name have this. So it will not be Shegun. So the first thing you do, you add up the ratio so that you can get the total. So since they say 5:3:2, it says it's equal to 5 plus 3 plus 2, which is what? 10. Okay, so for the first one, it will be 5/10. Second one, 3/10. Third one, 2/10. So for the first one, we'll have 5/10 times the profit, which is 21,500. So they will have to share that profit. So 5 divided by 10 times 21,500 is 10,750. The next one is IO. IO will now be 3/10 times 21,500. Okay, so we have 3 divided by 10 times 21,500 is 6,450. The third one is Biodun is 2/10 times 21,500. So 2 divided by 10 times 21,500 is 4,300. So when you add them together, it must and should give you 21,500. If it doesn't give you 21,500, what you did was wrong. Okay, so you have to what? To check it again. So when you add that together, this will now give us 31,500. Okay, so with that you have done your preparation. So it's remaining now the what? They say the current account. So we'll write here the columnar current account because it's in column. Okay, columnar current account. So have okay, so the first one is Shegun. I can represent it as X. Ayo and Biodun. Shegun, Ayo and Biodun. Okay, now the first thing we have to do, they say the current account, look at the balance they give us a current account. So Shegun is 1,000 naira credit. So we just bring it here, balance brought forward. Shegun 1,000. Biodun 100, the same credit. Ayo is not there. For Ayo, they said it's debit, so we'll debit it. So we'll have another one here, balance brought forward. Ayo is 200. So most times it can appear like this, whereby the balance brought forward, they are indicated for you. But if they are not indicating, they just say balance brought forward, it should be at the what? The credit side. Okay, take note of that. So at this point now, we've recorded all that is needed. Now we have to record now their drawings. The partners' drawings were this. So let's record their drawings. For Shegun, it is 7,000. For Ayo, it is 5,000. For Biodun, it is 3,000. Okay. Now another thing that is supposed to be here now is their interest on drawings. Remember we said what will appear here is what the individual partners will have to pay to the business. They'll have to pay back the drawings money. They'll have to pay the interest. So the interest on drawings is 700, 500 and 300. Okay, so the next one is the right hand side. Now everything that is here is to be posted here. So we have salary for Ayo. So we have salary here. Ayo alone is the one that have salary of 6,000. This one don't have, this don't have. Okay, now come to interest on capital. Interest on capital. So interest on capital, Shegun is 2,000. Shegun is 2,000. Ayo is 750. And Biodun is 1,250. Okay, the next one is share of profit. Share of profit. The share of profit, Shegun is 10,750. Ayo is 6,450. And Biodun is 4,300. Okay, I think that is all. So the capital cannot come there. So that is all we have to record. So let's now add them so that we can get our balance that was brought forward. So using my calculator for Shegun, Ayo and Biodun, I will have this as 13,750 and this as 6,000 plus I have 13,200 and this plus this, so this is 43 plus 1,250 plus 100 is 5,650. So 5,650, they are all greater than this, so we'll have a balance carry down here. So if we have a balance carry down here, so we have a balance carry down. So 13,750 minus this plus this is 7,700. So 13,750 minus 7,700 will give us 6,050. So that when you add them together, it will now give us 13,750. The same way, this total here minus everything here. So 13,200 minus 57 will give us 75. So when you add it, it gives you 13,200. While the last one, 5,650 minus 33 will give us 2,350. So when we add, we have 5,650. So that is that on appropriation and the current account. So that's how to prepare for the appropriation and current account. So in another question, we're going to see when we'll start from the topmost, which is the trading profit or loss account, appropriation account, the current account, and balance sheet. Ensure you like, comment, share, and subscribe to this channel. Partnership has series because when there is admission of a new partner, how you value goodwill when there is death of a partner, and also dissolution of a partnership when you evaluate assets and all that. We are going to see all that. Ensure you like, comment, share, subscribe, and comment your thoughts on this. Okay, thank you very much.